Why do real estate investment trusts, or REITs, finance real estate projects in California, one of the most dynamic property markets in the United States? Welcome to Real Estate Capital and Growth USA, where we explore how large-scale property developments are funded and structured. REITs are companies that own, operate, or finance income-producing properties across sectors such as housing, retail, or commercial real estate. In California, they play a key role in shaping urban skylines and supporting long-term property investments. In this video, we'll take a clear, educational look at how REITs typically approach financing projects, from raising capital to allocating funds within the state's diverse real estate landscape. Before we continue, please take a moment to review this disclaimer. This content is for educational purposes only and does not constitute financial or legal advice. Always consult qualified professionals before making any financial decisions. Now, let's begin by understanding the foundation of REITs themselves. Overview of REIT types relevant to real estate. In understanding how REITs finance real estate projects in California, it's essential to recognize that these entities come in two primary forms: equity REITs and mortgage REITs. Both categories influence how capital flows across the United States property market, shaping developments in major regions like Los Angeles, San Diego, and San Francisco. Each type of REIT operates with a distinct purpose but serves the same broader goal: providing consistent access to real estate investment opportunities while maintaining diversified sources of funding. This balance ensures that California's competitive market continues to grow and evolve in a sustainable, structured manner. Let's take a closer look at how these two types of REITs function and how they interact within the broader U.S. real estate ecosystem. Equity REITs and their core role. Equity REITs are the most recognized type of real estate investment trusts operating in the United States. These organizations focus on owning, managing, and leasing income-producing properties. In California's major cities, they often hold portfolios of residential communities, office buildings, healthcare facilities, and shopping centers. Rather than engaging in property sales or speculative activity, equity REITs generate income primarily through rent collection and long-term property management. This model provides a stable structure for the real estate market and contributes to ongoing development across California's urban areas. By reinvesting part of their earnings, these entities maintain growth and enable continuous modernization of the state's infrastructure. Now that we've seen how equity REITs sustain property ownership, let's explore the second major category, mortgage REITs, which focus more directly on real estate lending and capital flow. Mortgage REITs and funding operations. Mortgage REITs, or MREITs, provide another critical channel in the financing ecosystem. Instead of owning properties directly, they fund or acquire loans that are secured by real estate assets. This structure allows them to support both residential and commercial developments by channeling capital into lending activities. In California, where property values and demand remain consistently high, mortgage REITs often engage in financing projects indirectly, through mortgage-backed securities or structured lending arrangements. Their role is vital in maintaining liquidity within the market and ensuring that developers can access capital for ongoing construction or redevelopment initiatives. This lending-based model complements the property-holding nature of equity REITs, forming a balanced system of investment and funding across the U.S. real estate sector. With both structures working together, the combined impact of equity and mortgage REITs provides a comprehensive view of how capital is distributed across real estate projects in California. Integration and broader impact. Together, equity REITs and mortgage REITs form the foundation of how real estate projects are financed throughout the United States, especially in California's dynamic property environment. Their combined influence ensures steady capital movement, from construction funding to rental operations, supporting a resilient, evolving real estate landscape. These categories do not compete but rather complement one another. By maintaining this structural balance, REITs contribute to long-term economic stability and urban development across California. This overview is purely educational and does not represent financial or legal advice. It simply illustrates the interconnected framework that supports property financing through REITs nationwide. Now that we've explored the main types of REITs, the next step is understanding how they generate and channel funds for large-scale projects across the state. General financing mechanisms used by REITs. In the United States, and especially in California's real estate financing landscape, REITs, real estate investment trusts, rely on several sophisticated funding channels to sustain major developments. These mechanisms are designed to ensure steady capital inflow, while supporting diverse property investments across commercial, residential, and mixed-use sectors. At the heart of this system lie three core strategies: public stock offerings, debt financing, and retained earnings. Each mechanism contributes to how REITs expand, stabilize, and reinvest within the California market, an environment characterized by high property values and steady investor demand. Let's explore how these financing pathways function within the broader real estate investment ecosystem. Public stock offerings. Public stock offerings are among the most visible ways REITs raise capital. When listed on stock exchanges like the NYSE, REITs can issue shares that attract both institutional and individual investors. This inflow of capital enables them to purchase new properties or fund large-scale construction projects. For example, a California-based equity REIT might issue new shares to finance a multifamily complex in Los Angeles, or expand its portfolio of retail spaces in Silicon Valley. These offerings serve as a bridge between investors seeking consistent returns and real estate developers requiring long-term funding stability. Debt financing. Another critical component of REIT funding involves debt financing. REITs issue bonds or secure institutional loans from banks and private lenders to finance new developments or refinance existing ones. Unlike speculative borrowing, these debt instruments are usually backed by predictable rental income or property assets. In the California market, where construction and land costs are among the highest in the U.S., debt financing provides flexibility. Certain REITs leverage private money lenders for real estate deals or short-term institutional credit to maintain liquidity during market fluctuations. Retained earnings. Finally, retained earnings, profits generated from ongoing real estate operations, represent a self-sustaining form of financing. Instead of distributing all profits as dividends, REITs often reinvest part of their earnings into upgrading or acquiring new properties. For instance, commercial REITs may use retained profits to modernize office spaces or fund sustainability upgrades like energy-efficient HVAC systems. Over time, this reinvestment strategy strengthens the REIT's long-term financial position, reducing its reliance on external capital sources. These three funding strategies, public equity, structured debt, and reinvested profits, work together to form the financial backbone of California's REIT sector. They enable REITs to pursue new opportunities while maintaining transparency and operational balance. By diversifying funding sources, REITs ensure they can weather economic shifts and sustain development across one of the most competitive real estate markets in the United States. The role of equity in REIT-funded projects. Understanding how REITs finance real estate projects in California requires examining the crucial role of equity. Equity represents the cornerstone of REIT project funding, enabling these companies to purchase land, acquire properties, and initiate large-scale developments in both urban and coastal regions. This form of financing ensures that California developments, from multifamily complexes in Los Angeles to office towers in San Francisco, maintain consistency and operational stability without relying solely on external debt. Equity's presence allows REITs to strategically deploy capital while reinforcing the structure of their investment portfolios. Let's dive deeper into the mechanisms of equity financing and its broader implications for the U.S. real estate market. Equity as a capital foundation. Equity financing is the initial source of capital for most REIT projects. By pooling funds from shareholders, REITs can acquire existing structures or purchase land for new developments. In California, this might include high-demand urban properties in Los Angeles, mixed-use developments in San Diego, or luxury residential towers in San Francisco. The equity structure allows these entities to establish a stable foundation for operations while maintaining flexibility in property acquisition and renovations. It provides a structured mechanism for reinvestment, ensuring sustainable project growth across diverse real estate sectors. Dividend structure and reinvestment. A defining feature of U.S. REITs is that they must distribute at least 90% of taxable income as dividends to shareholders. This regulatory structure ensures that funds circulate continuously within the economy while providing predictable capital movement for further investments. For REITs operating in California, this system allows a portion of earnings to be reinvested into property enhancements, such as modernized office spaces, eco-friendly developments, or residential upgrades. By balancing dividend payouts with retained earnings, REITs maintain a strong, adaptable financial foundation. California-specific impact of equity financing. In California, equity-based REIT financing supports both urban and coastal projects, ensuring continued development without excessive reliance on external loans. Coastal cities, with their high property values and dynamic markets, benefit particularly from this consistent funding source. Equity also enables REITs to pursue strategic enhancements, such as sustainable building practices, energy-efficient retrofits, or mixed-use property expansions, strengthening the overall investment ecosystem across the state. Equity remains a foundational component of REITs financing real estate projects in California, providing the initial capital required for acquisitions, renovations, and sustainable developments. This method ensures that projects maintain operational stability while allowing reinvestment for long-term growth. While equity forms the base, it works in conjunction with debt financing to balance the overall financial structure of REITs. Together, these mechanisms support California's dynamic real estate landscape in a structured, educationally observable manner. Debt and mortgage strategies and financing. In California, REITs finance real estate projects not only through equity, but also with debt-based strategies, which expand their funding capacity and diversify capital allocation. Debt enables REITs to scale projects efficiently, supporting urban redevelopment, commercial complexes, and residential communities. Mortgage REITs specialize in providing loans secured by real estate assets, while hybrid REITs strategically combine debt and equity to maintain a balanced financial structure. This approach ensures that California developments, from bustling downtown districts to growing suburban neighborhoods, benefit from steady and structured capital flows. Now, let's explore how these debt and mortgage strategies specifically influence project funding in California. Mortgage REITs and lending. Mortgage REITs provide loans secured by real estate, offering financing to developers who need capital for new construction or property acquisitions. In California, these loans can be applied to multifamily housing projects in Los Angeles, commercial centers in San Diego, or retail expansions in Bay Area cities. The structured lending process ensures that funding is aligned with market conditions, property valuations, and investor expectations. While debt introduces repayment obligations, it also enables REITs to diversify investments without immediately drawing on equity. Hybrid REIT strategies. Hybrid REITs combine both equity and debt strategies, creating a balanced financing model. This dual approach allows flexibility in scaling projects, as residential, commercial, and mixed-use developments across California can be funded according to market dynamics. For instance, a hybrid REIT might use equity to secure land for a new office building, while leveraging debt to cover construction costs, optimizing capital efficiency while maintaining operational stability. Portfolio diversification. Debt financing supports the diversification of REIT project portfolios. By combining mortgage lending with equity contributions, REITs in California can maintain a steady rhythm of property construction and redevelopment, from urban centers to suburban expansions. This blend of funding allows REITs to strategically distribute resources across residential towers, office complexes, and commercial hubs, contributing to a resilient and adaptable real estate investment ecosystem. Debt and mortgage strategies complement equity funding, providing REITs in California with the flexibility to scale projects, diversify investments, and maintain consistent development activity. By balancing these financing channels, REITs can support a wide range of property types while preserving portfolio stability. This structured approach demonstrates how California's unique real estate market shapes funding strategies, ensuring REITs can meet ongoing development demands without relying solely on one type of capital. California-specific market dynamics for REIT financing. Understanding how REITs finance real estate projects in California requires considering the state's unique market dynamics. California offers a blend of high population density, diverse economic centers, and evolving environmental standards that shape investment strategies for both residential and commercial developments. These dynamics encourage REITs to integrate sustainable design, renewable energy solutions, and adaptive reuse of existing structures. Such measures are increasingly observed across California's urban and suburban projects, ensuring resilience and alignment with local market expectations. Let's explore how these trends specifically influence REIT financing strategies across the state. Urban development influences. California's urban centers, including Los Angeles, San Diego, and San Francisco, are focal points for REIT-financed projects. High-demand residential towers, office complexes, and mixed-use developments rely on structured financing methods to meet market needs. By integrating equity and debt strategically, REITs can support large-scale urban projects that accommodate population growth while maintaining financial stability. This approach demonstrates a practical alignment of funding strategies with local economic realities. Sustainability and regulatory considerations. California projects increasingly incorporate sustainable practices, such as green rooftops, solar panels, and energy-efficient retrofits. While REITs do not provide legal or financial advice, these choices reflect general market expectations and publicly available environmental guidelines, influencing how capital is allocated for construction and renovation. Sustainable-focused investments also align with long-term value preservation, allowing REITs to participate in projects that meet both market demand and evolving environmental standards across the state. Regional diversity and market adaptation. From San Francisco's bustling commercial zones to Los Angeles's multifamily neighborhoods, REITs must consider regional differences when financing projects. Coastal cities often require higher capital allocation due to property values, while inland regions may focus on mixed-use or industrial developments. This regional variation ensures that California's diverse real estate market is supported by adaptable and descriptive financing strategies, enabling REITs to contribute to ongoing urban growth in a balanced, sustainable manner. California's market dynamics significantly influence how REITs finance real estate projects, encouraging strategies that integrate urban density, sustainable practices, and regional adaptability. These insights demonstrate the broader context of financing within the state, highlighting how REITs can support a range of developments without reliance on advice-driven or promotional approaches. The patterns observed in California also provide valuable educational examples for understanding U.S. real estate investment structures. In summary, REITs finance real estate projects in California through a balanced combination of equity capital, debt instruments, and operational income. This structured approach supports a wide range of developments, from multifamily housing to commercial centers, while contributing to California's overall economic and urban landscape. By using these financing mechanisms in combination, REITs are able to maintain consistency in project development across major urban hubs, including Los Angeles, San Francisco, and San Diego, demonstrating the functional and strategic role of capital allocation without providing financial or legal advice. As the real estate environment evolves across the United States, REITs continue to play an essential role in the broader property financing framework, providing an illustrative example of how structured investment strategies support diverse developments in dynamic markets. Before we wrap up, always remember, this is educational and informational content by Real Estate Capital and Growth USA, exploring the structures that shape the U.S. property market. This is not financial advice. We provide only general insights into REIT financing in California. Thanks for watching. Subscribe now and stay tuned for more deep dive videos on U.S. real estate and capital growth.